What makes you so bullish on natural resources at a time when central bankers are trying to bring inflation down? Commodity prices could also come down.
Commodity prices will fluctuate and will come down, but the trend will continue to be up in dollar terms, because the U.S. dollar, as you know, has gotten weaker. With central banks raising interest rates, there will be some damper on growth, but still the demand for commodities will continue to be there because your per capita incomes have been rising. Yes, okay, you go from 8% maybe to 6% or 5%, but if your population is growing at 1%, per capita incomes are rising, which means that your demand for commodities will continue at a good level.
You're bullish on copper, Mark. Copper is the best performing asset class in the last 3 years. Are you confident of the demand versus speculative scenario for copper?
I believe that demand for copper will continue at a high pace because of the not only Chinese demand but Indian demand. Every house needs copper. Of course, when prices get too high, you get some replacement, whether it be aluminum or something like that. But the demand for copper will continue to be at a high level. Prices may have gone a little bit too far, and you'll get a correction down, but that trend line will not change. The trend will definitely be up. Why? Because you've got increasing demand long term. Because if you consider Chinese and India alone, over 2 billion people, if they want a standard of living the same as Europe and America, they need a lot of copper. And that's what they want, and that's where they're going. In addition, mining for copper is getting more and more expensive. So you put these two together and you realize that the trend is definitely up.
For next 1 year, Mark, which asset class do you think has potential to outperform the most? Bonds, commodities, equities?
I would say probably equities.
And why do you say that?
Simply because they reflect what is happening in the commodity market. Because if you're buying companies that produce these commodities, that their earnings will reflect what demand supply situation is. That's number one. And number two, as inflation moves up, which it will as a result of money supply, people will begin to realize that in order to preserve their wealth, it's got to be in equities, because equities will adjust to inflation.
Indian stocks, are they fairly valued or are they attractively priced?
I would say fairly valued in most cases, but there are a number of opportunities where prices are undervalued, and that's where we would like to go.
You just made a remark that Indian small cap stocks are looking attractive. Are you looking at investing in any of the small cap stocks? Because you run a large global fund, and liquidity and size could be a problem for you when it comes to small cap investing.
That's right. So what we've done is we've established small cap funds that specialize only in small cap, both for Asia and the world. And a lot of money is going into the Indian small caps as a result of that. There are many very well-run, profitable small caps in India. The selection is incredible.
The two themes, if I look at your portfolios, which you are bullish on, one is consumption and the second one is commodities. Why do you like Indian natural resource companies? Some of them are dependent on ore, some of them are not integrated at all.
Well, if you take iron ore, Tasic Ore as an example of a company that has got tremendous profitability, great export potential, great local demand. So I'm not recommending the stock, but I'm just saying there's so many good stocks like that in the materials or commodity sector.
Is Tasic a good buy even after the Kane deal, because that is unnecessary diversification for them?
Well, it depends on how you're looking at it. If Cairn can return better than iron ore, then it's a good investment. That's the kind of calculation you've got to make, because diversification is always good if what you're diversifying into is as good, if not better, than what you're already in. So if the margins for Cairn, now that oil is going up, are better than for iron ore, you're enhancing value rather than subtracting value.
If I look at your other position in your declared portfolio, you're bullish on Maruti, which is a four-wheeler. You're not bullish on two-wheelers. Any reason why you're bullish on four-wheelers, not two-wheelers?
It's a combination of things. It's not necessarily whether it's four-wheelers or two-wheelers. It's the company themselves. Where's the valuation? For example, you could have a two-wheeler company that's very, very profitable, more profitable than a four-wheeler, but the price has already reflected that, so we don't go into it. Doesn't mean we don't like it, but it's just the pricing. So we really evaluate each company on its merits.
So would you like to buy for next 2 years, next 3 years, companies which are commodity owners or companies which are commodity consumers? Because one side you're buying Sesagoa,
Yes.
which is a commodity owner, second side is Maruti, which is a commodity consumer.
Yeah. Well, let's put it this way. If the commodity consumer can adjust the prices to the changes in commodity prices, we want in. In other words, we want to find a company that can adjust pricing, that has pricing power, can adjust pricing to the rising prices of commodities. So if a company doesn't have that power, then we better stay away. We've got problems because, as you pointed out, commodity prices are moving up and their costs are going up, and they will be squeezed unless they can change prices.
Mm-hmm.
So that's really the key. It's not so much whether they're dependent upon commodities, it's whether they can adjust prices to the rising price of commodities.
The other key position in your portfolio is Hindalco. Do you like non-ferrous more than ferrous?
Not necessarily. We like both. We've got both in our global portfolios. Again, it depends on where we're seeing these companies in 5 years' time. We do know that the demand for aluminum is rising and will be increasing on a per capita basis very fast. So we do want to get exposure, provided the price is right for those companies.
You have a limited exposure to IT and a limited exposure to banks. They are two key heavyweights. So banking is about 26%, IT is about 10-12%. That accounts for about 40%. So you are underweight on 40% of the Indian market.
Actually, we, on a global basis, we have very big holdings in IT and banks. Banks are one of the big sectors for us. Whether we're over or underweight, it depends on what index you're looking at, but those two sectors are quite important for us. So it definitely, I would mark them at a high point. Banks in particular, because they reflect consumer spending. We want to get exposure to consumers, and banks are one way to do that, because they're going into consumer banking. So it really is something that we look at very, very carefully.
Can I safely assume then, and correct me if I'm wrong, that you're bullish on private banks more and PSU banks less?
No, because the nice thing about state-owned banks is that they don't go bankrupt.
Is that a risk for India? Is that a risk for Indian banks? That some of them could go bankrupt?
No, I'm not saying it's a risk. I'm just saying that all things being equal, let's say you have two banks. They have the same return on capital. They have the same growth prospects. Loan-to-deposit ratio is the same, so forth and so on. I would go for the government-owned bank rather than the private bank, because your downside is limited in the government-owned. Of course, all things are not equal. There are differences. And one of the things with private banks is that you often can find a very dynamic management that can grow faster without necessarily increasing risk. In the government banks, often they are subject to policy directives which may not be profitable. So it's something that you've got to weigh back and forth. So you'll see in our portfolios, we have both. We have both government-controlled banks and private banks.
For someone who predicted the internet bubble right in 1999, we are taking the clock back 12 years now. What is your big global prediction now?
The big global prediction is that volatility will increase. We'll see a lot more volatility. Secondly, the perception of emerging markets is changing to become more positive. It's becoming an important asset class for investors. And that's a sea change, as you know. 10 years ago, this is a very considered to be a very risky arena.
Do you think emerging markets now are more like a must-have for global investors? Because what I understand is that after 2008, global investors have a very high weightage to fixed income securities, and a very low weightage to emerging markets, or for that matter to US equities now.
That's right. Of course, the big pension funds in America and Europe have been into equities for quite some time because they realize they've got to, in order to grow in line with, better than inflation or in line with inflation, they've got to be in equities. But there has been a sea change, I think, towards the realization that you've got to be in equities and you've got to be in emerging market equities.